What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Rebekah Taylor. How are you doing today?
Doing good, Dan. Thank you. How are you?
I'm fantastic because, after all, my very favorite audience member is watching this today. And why is my favorite audience member here watching today? Well, this is a chance encounter where I interview commercial real estate investors, syndicators, operators, stuff like that. Now, why would I do such a silly thing? Well, if you've ever heard of off-market, private, or 506B deals, you'll know that you have to have a documented prior substantive relationship, or else the SEC will get ants in its pants. So that's why I'm here, finding out level of sophistication, appetite for risk, core competencies they look to contribute. And the main thing is that you, yes, you, get to learn how to effectively communicate on the subject of commercial real estate deals. But before we deep dive into Rebekah's business, Rebekah, do you want to say a thing or two about yourself?
Yeah, I'm glad to be here today. It is nice to be on your show. Thank you for the time. And I'm based in Lynchburg, Virginia. I been married 15 years, been investing in real estate since 2012, and I have almost three kids. I have a kid on two kids and one on the way very shortly. So they keep me busy.
Excellent, excellent. Good stuff. And so I'm sure that has something to do with your motivations. But before I do that, I got to say, but wait, check your eight. Rebekah, I don't know if you can see through the camera and down in the, like, down at the, down there might be this hideous subscribe button, and they should probably do something. Okay, it's a stupid joke, but I do it in every episode. But the first segment here is the five distinct motivations. I've met all sorts of investors and syndicators, and everybody has their own unique why, but at the same time, I found they fit pretty neatly into these five different categories, and we all have to know what's going to keep somebody going. So that's why I always ask. The first motivation is preservation of purchasing power. What's that? Well, there are some people out there who already have enough assets, a portfolio, and the way that they make ends meet is from the proceeds of ownership. So if you're in that situation, why would you go through all the effort of making a new acquisition? Well, if inflation is eating away at your purchasing power, or you can buy at a steep discount, like when there's a crash or distress or other situations like that, that is when they're going to be doing it. I'm not there yet. Where I am is trading time for wealth. My background is in technology, which made me a high wage, high salary earner. And what I was doing is I was doing the CRMs in tech for an Ohio firm, watching the boss flipping 10 houses a month, or at least do 10 transactions a month. And I realized I'm paying more in income tax than anybody else. So how can I pivot to where my effort is being rewarded in the form of deployed capital, aka wealth? So that's why I'm in this industry. But a lot of people, that's a little bit too abstract for them. More what they're focusing, especially if they're new, is they want to take control of their schedule. Maybe it's fast track retirement, or maybe they just want to work fewer months per year or fewer weeks per month or something like that. And that's why they're making these acquisitions. Whereas the next group, it's not about dialing it back, it's about scaling it up. They are so ambitious, they want to buy their entire hometown. They want that generational wealth to make sure that their great grandchildren never have to hold a day job. And that's why they're making acquisitions. Whereas the last group, they're also going to keep on hustling into their 90s, like the ambitious one, but they're more focused. They've picked a sector of society, or maybe it's the environment or animals, or they want to send people to space. Who knows? But they really want to do these acquisitions to build that wealth, because they realize you have to have a pretty big financial backing if you're really going to make a big impact. But Rebekah, of those five different motivations, what combination of those would you say describes you? What really jumped out to you through those?
Yeah. Probably trading time for money. I also come from the tech world. I spent 10 years doing sales and marketing for them, made great money, but was working my butt off and traveling a lot, not having time for my family, the people I love most, getting to do things that I really enjoyed. And so that would probably be the big one. And then I guess early retirement, I don't want to work till I'm 65 or 70. Like my husband and I have decided that's absolutely not an option for us. And not to say that we won't work for many years, but we want to work doing things we love that are adding value to other people, making a difference in the world. We're very involved in our church. We like to do missions work. We want to have the time and the money to be able to invest in that and not be strapped to a 9 to 5 cubicle job.
I love it. I love it. But of course, there are risks involved in commercial real estate, and that's one of the important things we have to figure out is like, do people understand the idea of a illiquid asset? And I went through, if you've ever been involved in a 506B deal, securities attorneys insist that you fill out this questionnaire. It's really invasive with a bunch of financial questions that you're probably not comfortable answering, and you'll end up revealing more about your finances than you probably know about your own parents. But the one question I wasn't very enthusiastic about was the one assessing people's appetite for risk. So in this show, I have my own fill in the blanks question that I think answers that question a little bit better. There are many popular investment asset classes, but I think blank is too risky. So inside real estate, outside real estate, Rebekah, what's too risky for you?
Oh my gosh. We talked a little bit about this ahead of time, and I was really trying to rack my brain. I think inside real estate, probably one that I'm a little bit cautious of is office space. We've seen a lot of changes over the last year on that front. I mean, I've been working from home on and off. Gosh, I started in 2012 working from home for 5.5 years, and then went back to an office for about 3.5 years, then started working from home again after that. And I haven't gone back. So I guess I just see a lot of fluctuation on that front, and a lot of empty office spaces. And so I guess I'd just be a little hesitant on that. Not to say you can't make great money, but I don't know that asset class as well. So I'd be a little bit more on the fence about investing in that.
That makes sense to me. So you're not gobbling it up like this scribe sandwich. This thing just kills me, right?
That's right.
It's not so subtle, but that's the segue that I use to bring out the Dan Does Deals Core Competency Cube. You can get your free copy at dandoesdeals.com. And Rebekah, you mentioned marketing, and one of the dumbest things you can do from a marketing perspective is give away your freebie without collecting your contact information. And that's exactly what I did, because I want to make sure you can confidently and efficiently talk about commercial real estate deals. And if you practice with these, you'll definitely get much closer. And in every episode of Chance Encounters, I go through all 6 sides. It just takes a couple minutes, and let's do it. So the first person I'm going to talk about is the repositioner. The repositioner is an acquisitions person. So they're looking at a bunch of different properties and doing a bunch of different paperwork. What's the paperwork? Well, there's a fancy word for the first thing they need to do. It's called underwriting the deal. That means they're doing the arithmetic. They're figuring out, first of all, is this dealer, this broker, this seller, are they actually being honest about how much the property is making? But they're called repositioners. It's not the most common word for it. Some people call these guys investors and these guys investors and these guys investors. But repositioners are a bit special because they're thinking, how can they change how the property is run so that it has more upside? And the one that's a little bit confusing when you first come into this is, why are they hanging out with financiers all the time? People who are involved in lending, they only deal with paper and money, and they do not have any operations duties or anything like that. But the answer is, if the repositioner can find a more advantageous loan, that goes straight to the profitability of the building. So they always have to have investor relations with different financiers. But the next place that the repositioners are going to look to find that upside will be the operations. They're going to stop those Benjamins from going down the toilet. But of course, there's more than just unclogging toilets and collecting rents. One thing that's handy if you have some great marketing chops, and it's one of my fortes that I bring to the table to my GP teams, if you have a vacancy rate issue, somebody with marketing chops has to step in, even if you are being managed by a third party or something like that, to get those vacancies gone. But operations, it's probably not enough upside to make it really worth it for the repositioner. So the other tool in their tool belt is a contractor team to do a value add or some renovations. The idea being, if the units are nicer, then people will be happy, at least the next residents will be happy to pay more in rent than the previous ones. But of course, you got to be very careful with how much money you dump into your value adds. If you're gold plating the toilets, you're not going to get a good return on the investment. So you got to be careful about that. But if you have the same problem that I have, see, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because you can bet that's not going to be me, because I'd still be stuck at an airport in an hour or two. But when the repositioner has assembled their team, they turn around to the financier and they say, hey, I found this awesome property that I want to pick up. Let's say it's 350 units and it's tens of millions of dollars. You don't happen to have, I don't know, tens of millions of dollars you want to lend us, do you? Well, there's going to be one other question that I haven't answered, and a lot of coaching programs and gurus, they kind of gloss over it. They're going to ask, who's your sponsor? Who's your KP? What's that all about? If you hypothetically, let's say you're a physician or an engineer or something like that, and you got a circle of friends, you're thinking, hey, let's take over some local commercial real estate properties and pool our resources. Well, that's going to fall apart as soon as you try to get a bank loan, because they're going to need somebody in the fold who already owns a similar asset. So if you want a 350 unit apartment complex, you need somebody who already has a 350 unit apartment complex. On top of that, you need a certain amount of liquidity. And then among the partners, you need a balance sheet of at least the amount of the loan. But if you got all those, you got yourself a commercial real estate deal. So Rebekah, as far as your core competencies go, like I know like every repositioner has some investor relations, but where do you fit on that die? What are you most likely to contribute to your next deal?
So my experience the last few years has been on the investor relations front, raising capital, helping on the marketing and sales. I mean, just naturally being in tech, I did a lot in sales and marketing. Again, I've been investing in real estate since 2012, though. So we've underwritten our own deals. We invest locally and have managed our own properties for many years. We have a property manager now that does some of the management as well. But so I understand it, and I can certainly look at deals and have a pretty good idea of whether or not it's going to pencil out and be the right fit for me to partner up with somebody on. But I would say underwriting is not my core strength. I just don't love being in spreadsheets all day. I've realized over time, like that's not something I enjoy. I want to be with investors. I want to be, interfacing with them and helping build trust, helping them feel comfortable with moving forward. Maybe it's not the right fit for them. And so just giving them the ins and outs and making it really clear and helping them reach their goals is really my goal in terms of when I go to partner with somebody. I'm not a lone ranger. I love teams. I love working with other groups and figuring out how we can all utilize our strengths and weaknesses.
I love it. I love it. And that brings us to the buy box. So when investors and syndicators are talking to each other, they're saying, hey, what you're looking for, what's your buy box, what's your ideal property? We're asking about three main things. First one is geography. Where is the property? What makes it ideal? That means what state, what county, possibly even what neighborhood, okay? So that's all gonna matter. Second one's gonna be size. Most of my guests on this show are in multifamily, in other words, apartment complexes. And the way that you define size in an apartment complex is by the unit count. And that's important because you're going to have a completely different group taking over 5-unit apartment complexes compared to the 500-unit apartment complexes. So the size definitely matters. But the third one, it's called class. And one of my pet peeves is when people use the same word for two completely different things. So I separate class into the condition. And what condition is, that's the first term here. The condition, it has to do with how old the building is, how beat up it is, and then of course, luxuries and amenities. But the second one, part of class, it has to do with the area. And when you're asking about the area, then you're talking about what's the crime rate like where the property is located? What are the school districts like where the property is located? And then of course, it's really a measure of desirability. So that also has to do with how many cars or people are going by that property in any given day. But both the area and the condition are ranked the same way as in grade school, where you got A+ at the top and then A and then A- and B+ and so on. So Rebekah, as far as you and your organization goes, where's the sweet spot? What's easier to say yes to and more difficult to say no to?
Yeah, good question. So I love multifamily, have been investing in multifamily for years. I think it's a great asset class. I do think in this current environment, it's a lot harder to find good deals. I've been to events throughout this year and last year, and it just, things have changed a lot. And so I've been a lot more hesitant on that front in terms of getting into deals. I've been doing some due diligence the last couple of weeks. I was just in Greenville, South Carolina with a operator, and Atlanta with a different one, looking at properties and vetting them. And so on the multifamily front, I just think it's harder and the numbers are just not always penciling out in terms of what I want to see delivered to my investors, with those returns. It's too tight. You have sellers that still have unrealistic expectations for where they can sell it at. And then we have interest rates way up here too. And we just can't make any money on it unless you're assuming some loans. And so on that front, I'm stepping back a lot. Not to say I wouldn't do a multifamily deal at this moment, but it just really would have to make sense and be, for me, really what's more important is the operator behind it, who is, what's their track record? How long have they been around? How many deals have they done? What's the exit? What are the exits looking like? What do the returns look like? Are they solid? Are they doing what they say they're going to do? And so that's more of what I'm focused on versus the asset class. I've been working on the last couple of months an assisted living deal up in Wisconsin, which that is a little bit different flavor of multifamily, but a huge growing need in our nation that I am getting more and more excited about, because I just see the importance of providing quality housing for this elderly population, that need a place to live, and there's not enough. And that population is just growing at an astronomical rate. I think it's set to double by 2060. It's coming, and we need a lot more housing for them. So that gets me excited, seeing the opportunities there, and then the chance to make a difference in people's lives and their living, areas. So that, right now that asset class has been very exciting to me. And not to say that I've invested in mobile home parks and self-storage, and, those are, I think, some great asset classes as well. More of my focus has been on the operator and my partner in the deal. Am I working with the right group? Because I don't want to do a deal with anybody. There's a lot of, unfortunately, people that might be, I don't even want to say shady, but they jump into things too quickly, or they get into debt they shouldn't. Unfortunately, that's what we've seen a lot the last year, is a bunch of bad debt, and things are not going the way that they anticipated them going. So I'm really more focused on the operator and the due diligence on that end.
I love it. I love it. Okay, cool. And so then the next question, then it has to do with who you're best suited to help. And everybody in this industry has their own unique skill set. But that really means that even though we're really eager to build new teams, give referrals and all that kind of stuff, there's some people that, we're better off helping. Me personally, because of my tech background, my marketing and social media content creation, blah, 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 blah. The sponsors and KPs I'm always interested in talking to, because they have the foundation that will really support somebody like me. And then of course the other one is the locals, because as I said, I'm from the internet. Now, Rebekah, I don't know if you have any 506B deals, so don't mention any 506B deals if you have them going on. But as far as who's out there who you think you're best suited to help, who should contact you?
I also, again, coming from the tech world, that's been kind of my network for many years. I have a lot of friends and folks in that arena. And also, I would say I'm a Christian, so I have a lot of people in my local area that I go to church with, like I'm involved in different missions or whatever it may be. And so that's another group that I'm really passionate about. Families, especially parents that are looking to maybe have more control of their schedule. I'm in a season where I have young kids at home, so I want to have more flexibility. And so getting to talk to moms or dads that are in that same position where they're trying to figure out, how can I cut back at work? I'm maybe not ready to leave my job, but I want to have a shorter work week. And so how do I subsidize my income? And so that's another group that I'm really passionate about helping, because I've seen personally the impact of having more time and not being so stressed as a parent, as a wife. Dan, you've got kids as well. It's a lot to balance. And so being able to have that flexibility is really huge.
Definitely, definitely. The primary caregiver it's a lot of work. And I don't care who you are. But as far as how to reach out, though, we ended up meeting through. I saw you on Don Spafford's podcast, and I see you on Facebook. I see you on LinkedIn. LinkedIn is the best way to reach me. I also have these. It's over here. This distinct last name, so that makes me pretty easy to find. But if you scan this code with your phone, that goes to the FAQs page of 506BME, which is the platform where I offer to syndicators and investors to document their substantive relations so that if they get audited by the SEC, they've got that buttoned up. They don't have to worry about the IT or anything. But Rebekah, if people want to reach out to you, what are the best ways?
I love the fact that you have a QR code. I need to do that. So that's brilliant. Well, thanks for that inspiration. So I'm on LinkedIn, very active on LinkedIn. Definitely connect with me there. My website is Tailored Investments. So you can see right here, it's spelled my last name. So tailoredinvestments.co. So check that out as well. If you're interested in scheduling some time to meet, I just love to get to know you and be a resource. You may not invest with me, you may invest with somebody else, but I'm pretty well connected in this industry. So if I can be a resource in any way, please don't hesitate to reach out and schedule some time.
Awesome.
And that's on my website, the link for scheduling meetings on my site.
Perfect, perfect. So then the last thing then, it's actually not for you, Rebekah, it's for you in the audience there. And it's a public service announcement. If you've been watching this episode and you've been experiencing like searing pains in your eyeballs and like migraine-like symptoms, I'm really confident it's the hideous subscribe button's fault. And if you want to get rid of it, you just click on it. It's free. It doesn't cost you anything. And of course, I'm biased. I want people to click on it because if enough people do, then YouTube will start paying for these videos instead of me. And I think that would be totally rad. As far as the trade-off for you, it means my videos might show up on your list of suggestions, but you can go ahead and ignore those suggestions because frankly, I just appreciate the fact that you spent this time with me. Just like Rebekah, I appreciate you joining me today. It's been great getting to know you a little bit better.
Yeah, thanks, Dan. It's so good to talk to you. I appreciate your time.
Awesome. Thanks.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.